Well, hi traders, how you going? It's Chris Weston here, Head of Research at Pepperstone. We're going to go through all parts of the gold market and perhaps a little bit more because I think there's some really interesting dynamics that are playing through in some of the currency markets, obviously commodity markets, which are obviously linked to what we're seeing in the gold market through inflation expectations and the impact they're having on real rates, for example. But, it's been an interesting week in the gold market, precious metals more broadly. If we go into the performance that we can see over the last 5 days in US dollar terms, you can see gold they're up about 1.1% in dollar terms. You can see silver, platinum, and more, certainly platinum down 3.4%, but palladium is all having a few headwinds coming through. And in terms of the FX markets, for the last 5 days, if we go to the performance relative to the dollar, it's been a fairly mixed picture. You can see here some of the petro currencies starting to find a few sellers. There you can see the NOK down 90 basis points, the Rand's down 2.6. Brazilian's done quite well, that's had a strong gain, and the Aussie, which we'll focus on a little bit more, up 55 basis points, which kind of, you've got these two conflicting tales going through in the Aussie at the moment. One is this ridiculous move that we've been seeing in the rates market and swaps markets more broadly across the curve. What's now being priced is incredibly extreme, and that's supported the Australian dollar at the same time. You're starting to see iron ore prices crater today. You've got iron ore futures down 7.9% in Singapore, and Dalian futures down 6.1%. So you've got those two factors. The Australian, the premium, or what's being priced in Aussie rates, are just absolutely flying relative to any other country except New Zealand, really. But at the same time, we've got industrial metals and ferrous metals coming under a bit of pressure, and that's causing a little bit of weakness playing through. But generally speaking, if we're looking to buy gold this week, then we obviously want to do it in the weakest currency, and the one that we offer is probably the pound or the euro there. So buying gold over the last 5 days in euro or pound terms has probably been the best place, and buying gold in Aussie dollars is where you've been seeing the underperformance. If you wanted to short gold in Australian dollars, you've probably done a little bit better in that situation. But let's go to the gold price and have a look at how it's fared before we start going into some of its key relationships. So if I go into the trading view chart, so you can see, we talked about this downtrend that was in play. We broke through that last week. What I wanted to see was as a retest. We've seen that retest now, and we're finding a few buyers. We've seen it break through there, but it hasn't closed through the downtrend, the former downtrend. It's very important indeed. Now, we've obviously got a lot of support coming through into 1782. I say a lot, but we've seen a couple of days where the buyers were very, very keen to accumulate gold long positions here in spot, just about sort of 1782. So if those levels, if we do see a reversal and it can chew through those prior bids, then those people are going to probably be forced to cover some of those long positions. We might roll back down to sort of 1771 in the short term. The way that I like to play this, though, I'm a big believer in buying strength in terms of CFDs and derivative positions. Short-termism is what we're kind of representing. I believe that let the trade come to you. When the flow of capital is all sort of aggregated into one direction, you can hitch a ride and just let it gently move up as well. And the way that I would like to play that is while I'm looking at a daily chart here, you can see just on the sort of bigger time frames there, you can see that there's a bit of resistance coming through into those highs around 1810. We talked about this level last week. This was actually the implied volatility level that we looked at potentially doing mean reversion levels, and that worked quite well. But I think if we could get a closing break of this 1810, then I think we go up to 1833, which, as we talked about before, is just an absolute behemoth level in the gold market. If we can see a weekly close above this 1833 level, then it can build, and I think that's going to be a really strong buy signal for me. So we've got all eyes on 1833. If we can get a bit of a push through this level, I think we'd be looking to buy stop orders. And this is where the order execution comes in with trading. It's not just about limit orders for swing traders, but you can also leave stop losses above the order. And a lot of new clients are saying, why would I buy a position? Why would I take a worse price? Well, the whole idea is that you're waiting and hitching a ride, and effectively, if you go on Newton's law, you're basically saying a body in motion stays in motion. That's really what we're doing. We're waiting for the price to sort of just generally gradually move above there, and we'll take a ride into 1833. I want to see how price behaves and reacts around 1833, if it happens at all. And if it can close above that, then I'd certainly be looking to establish a bigger core position in gold going forward. But we've taken through the downtrend like that. We've tested this level now. That's become support. You can clearly see that the market is very happy to defend that. So it feels like we might squeeze back above this level. Where am I wrong? Where am I happy to flip to short positions? Well, I think firstly, I mean, clearly if we go through these levels, 1782, I think we sort of take a slightly more negative bias. And I think if we go back around through 1768, I think we might start trending. You're going to see some of these momentum indicators, the oscillators start rolling over back through 50 on that situation. And I think, if we can build for 1833, I wrote about it in a piece this week. The thing that we need to remember, and we saw it in Tesla this week, is flow. CTAs, or systematic trend following funds, who are buyers when their rules dictate. I think they're going to be the people who bring the capital into the gold market through gold futures. Obviously, that's going to trade through into the spot market as well because of the arbitrage that's going to be taking place. And I think when it starts trending in a more positive fashion with that rate of change picking up, those systematic funds will start kicking in as well, and that will just perpetuate the move up. And of course, that will just happen if in this situation. So for me, I really like the structure that we're seeing in the gold market in US dollars, but now we need to see it really manifest going forward. Let's have a look at it in some of these other currencies and see how we're doing here. I'm not really too sure about the Australian dollar because the Aussie's been pretty strong, as we talked about there. What are we seeing in some of the other currencies? Well, I quite like what I'm seeing in gold in sterling terms. I'm actually just going to take this out here and I'm just going to move this level, which is a legacy issue from last week. Again, just waiting for that buying to come through. Wait for the breakout, 13, 16 in sterling. And again, for me, it's just waiting for the daily close. I've got a daily time frame. We wait for that bar to close above that period, just to give you that reinforcement, that confidence that it's closed above that level. Then I think, we can sort of just take that up and hitch a ride, potentially for 13.50. But this is what we're doing. We're waiting for the market to push through here, show its emphasis to trade through that going forward. And I think we can look at that. The yen was one that I was looking at last week, and so I wasn't particularly keen on buying gold in Japanese yen terms, really because I thought the Japanese yen was so overcooked in terms of oversold that I thought it was going to have a short covering rally. Well, we did see that to a part extent. But is this now ready to make a resumption of this bull trend that we saw from September to October? Again, a lot of that's going to be down to what we saw in the yen. And if we go through some of these yen crosses, well, obviously Aussie yen's been the big one that everyone's been focused on. You can sort of see this previous high coming back to May. We're just struggling to sort of take that out at the moment there. So we've got this kind of made a high here, which made a lower high here. And really, again, I'm just this momentum trader in me wants to say, Chris, buy Aussie yen above 86. Wait for that move to reestablish itself. Wait for the to buying coming through there. Again, looking to take short positions and maybe flip this to a more bearish structure through this swing low of 84.60. Are we going to see that move in the yen? Well, I'm not really too sure. But let's have a look at this Aussie move. When we're talking about gold in Aussie dollar, what we've seen is an absolute stonker of a sell-off coming through in the Aussie market. I'm looking at rates markets here. I'm looking at swaps markets more prevalently here. If you have a look at 2-year, 1-day swaps in the Australian market, and subtract that against what we're seeing in the US, just look at rate differentials in a 2-year perspective. Aussie 2-year rates now are trading at a 66 basis point premium to US rates. For so long, the RBA had been pretty much in terms of lockstep with what the Fed are doing. We're now 66 basis points in terms of 2-year rates above US. So that's been very positive for the Aussie. Have a look at this second one against euros. We're trading 189 or 1.89% above that of Europe. Against the New Zealanders, well, we're still trading at a discount, but it's certainly way less. I mean, the market's really rich in terms of Kiwi pricing. But you can see that we were negative 143 basis. We're now negative 1 percentage point, really below what the Kiwis are expecting over the next 2 years. And Aussie against the pound, you can see nearly 2 rate hikes of additional premium baked into the Aussie rate markets. We're pricing in nearly 8 or 9 rate hikes over the next 2 years in Australia. Is that going to happen? Absolutely not, in my opinion. The RBA have macro-prudential, or the housing regulator, APRA, have macro-prudential, which they can use to call the property market. We're still doing QE. We'll wait till the February meeting to reassess that situation. But there's no way, in my opinion, that they're going to raise by that amount and into what is largely a supply side situation. Okay, demand's going to kick up as we come out there, but that's been the big trade for me in terms of the Aussie dollar. It's just look at those rate hikes and look at the relative premium that we've been seeing. Aussie against the US dollar. We've got this move here. I like the structure that I'm seeing. We've broken through these these previous highs that we saw back in September. The market's just consolidating above there. Again, I just want to see this kick up. If this kicks up, I'm going along for the ride as a momentum trade and as a trend following trade. You can see that it's just holding the 5-day exponential. If it can break through the 75.20, I'm in that trade as well. But, there's a lot being priced into Aussie rates. And if we have a look at, as I say, what we're seeing in some of these Chinese metals and Chinese bulks at the moment, they are getting absolutely taken downtown to Chinatown today. So it's getting a bit beaten up. And that's really what we're reflecting in the gold price there in Aussie dollar terms. So an interesting one. Let's have a look at gold positioning at the moment. Go to the manage flow, manage money. 69,000 longs. It's still not particularly punchy by any means at all. That gives me some belief that if we do break through that 1833 level, we can build on that going forward. I want to have a look at real rates, because real rates obviously in the gold market go hand in hand. The correlation is not one for one by any means at all, but you can see that the relationship here, that US real rates, so inflation adjusted treasury rates, they're going down, as you can see here, because inflation expectations are moving higher than nominal treasury rates. And when you subtract the two, you get what we call a real return, and that's really important for fund managers. It's not just about the nominal yield that you get, but when you actually adjust this for inflation, that's when you get what we call real returns. It's really important. It's you stick your money in a bank account, you might earn a very small amount of basis points, but when you actually adjust it for inflation, you're getting a negative real return. That's what central banks wanted. They wanted to take that money, push it out the risk curve, and try and get some sort of return, and that's why equities have done quite nicely in that situation. But have a look at what we've been seeing. Real rates in the US continue to head lower. Inflation expectations have been pushing higher, mainly as a result of what we've been seeing in crude and energy, natural gas, and you've been seeing the back end of the curve really not really taking too much in. It's all been moves sell off in the front end, and we've seen bear flatteners playing through. But you can see that move in lower in real rates has supported the gold price. So really, if I want to take this down, what we're going to be seeing, if what's going to take us through 1833 is real rates, real what we call treasury inflation protected securities. You can see them on things like TradingView, and I think there's on the Fed's website. You can have a look have a look at Fred, the St. Louis Fed's website. You can see real rates there, real treasury rates. And if it breaks through these levels, negative 120 basis points, that will take the gold price up to 1833. That's really what we're looking for as well. So that's very, very important indeed. Going back to that Aussie market, crikey, look at that. Aussie 5-year government bonds now trading 28 basis point premium to that of US Treasuries. You can see why people have been bidding up the Aussie on the back of that. And I think this is a really interesting chart as well. Have a look at this. Just getting away from the gold market, but it will have ramifications for gold, I think. And this is the implied volatility that we've got to see in rates market, interest rate markets. You can see they're now trading at really probably the highest levels since the Volmageddon situation during the pandemic. And you can see bond volatility also at the highest level since that. So we've seen rates and bond volatility, implied volatility, really, really going for it. But look at equity volatility. Yeah, it's just turned up a little bit there, but it's multi-year lows, and you can see that in FX volatility as well. You can see it's had a little bit of a gradual climb, but FX volatility still pretty low, it's pretty subdued relative to what we've been seeing in rates and bond volatility. Now that suggests that the rates volatility suggests that we are going to see a pickup in range expansion in FX markets and also equity markets. I think we'll probably see the VIX back above 20% on the back of that as it mean reverts relative to these two key asset classes. Will that have a big impact on gold markets? Obviously yet to be seen. But what we're seeing at the moment is those rate markets are really showing big volatility, and I think we're probably going to see some opportunities to buy volatility in some of those over markets as well. Now, next week we do get the Fed meeting. That's going to be a biggie. Why is it going to be a biggie? Well, it's going to be symbolic. They're going to cut back on asset purchases. They're going to take the pace of QE down by $10 or $15 billion. I don't think the market's going to move on the back of that. It should be the most telegraphed thing we've ever seen in financial markets. But we've also, that same day or that same 24-hour period, we're going to have the OPEC meeting, and we're also going to have the Reserve Bank of Australia meeting. Will the RBA acknowledge some of these inflation forces? The market seems to believe there could be one or two words that are being tweaked. Now, because inflation expectations are so important to the gold market, and those inflation expectations are being completely driven by what we're seeing in oil prices. Have a look at this chart that we're seeing now in Brent crude. This is the one that the OPEC nations look at. We've broken this channel. We'll see if that can reclaim that 5-day MX moving average and back into the channel a session ahead, or will this start rolling over? If that does, we could see inflation expectations moving a little bit lower and real rates could push up, which could be a negative for the gold market. But we've broken this trend. It'll be interesting to see how the market trades this into OPEC next week. We saw a bit of a build in terms of inflation inventory numbers, which have weighed on the crude price there. And obviously everyone's watching what's happening between the EU and Iran as well, and whether we can see additional supply coming on there. But again, looking at WTI as well, yeah, I think if we're going to get a close, below this low here, then I think that could be short positions back down into 76.82. And again, that could be negative for gold because real rates will probably rise on the back of that. So we are really watching these commodity prices very, very closely. Have a look at natural gas. I think that looks a little bit better. Yeah, again, waiting for that just to kick up and probably go along for longs in the back of that as well. So really interesting structure at the moment. Let's just go back to our good friend gold just to wrap this up. We are watching what's happening in real rates as we've seen that relationship build. But if real rates continue to fall, and that's going to need a higher crude price, the way that I'm going to be trading that is I'm going to wait for the momentum just to push me into a position, say, Chris, come and trade me, take a long in this position now. And that's going to be through 1810 for 1833. I think we'll see some wood being chopped there. I think the market's going to struggle to get through in there in the short term. But if it does, that's going to be very, very symbolic for the gold market. It's going to open up a lot of upside, in my opinion. Whether it gets there is yet to be seen. But obviously with trading, keep an open mind. If you found yourself liking this video, just click the like button. That would be really, really appreciated. If you've got any comments, leave comments, whether they're good or whether they're bad. Love to hear from you all. Otherwise, I'll see you all next week, and good luck in your trading.